Hey YouTube, it's Matthew Decker, Leveraged Wealth Management. I hope that you're doing well today. Today I'm going to do a recap of a video that I did 2.5 to 3 years ago on fees associated with index universal life insurance policies. Now I'm going to link that video that I did in, I think it was late 2018, maybe early 2019 on fees above, and I'll put it in the description below. That's still a good video to outline the fees associated with these different products. And I'm going to recap some of those fees here today, but I want to do it with a little bit of a twist, maybe a little bit of a different flavor, because in the last year, really in the last 6 months, there have been several different industry regulations that have changed the way that index universal life insurance policies are illustrated. And because of that, it can be difficult to decipher some of the fees. And really what we're going to get at is fees in the absence of value, because that should be the discussion. Whenever we talk about fees associated with index universal life insurance policies, you have to understand that fees are just one side of the equation, or maybe a better way to say it would be they're just one variable in a very large equation. So we're going to recap the fees that are associated with these index universal life insurance policies. And then I've got one example that I just want to show you how maybe we should reframe the conversation around fees. So let's go to the whiteboard here real quick. And I just want to briefly go through the different fees on these policies. So whenever you look at an indexed universal life insurance contract, and specifically the fees, there's going to be anywhere from 3 to 6 line items of fees. So the first one is going to be simply a premium load. Now, not every single policy is going to have a premium load, but most of them will. And what you will find is policies that don't have a premium load will have higher charges in some of these other line items that we get to. But a premium load is very simple. When you pay a premium, there's a fee that's associated with that premium. It's usually a percent of the total premium, and half of that goes to pay taxes and half of that goes to the company. And that premium load is typically fixed for a set number of years, or it may be fixed at, say, like a 5% fee and then drop to a 3% fee or something along those lines. But anytime you pay a premium, there's going to be a premium load. That's the first fee that's going to be on these policies. The next one is going to be a per unit charge. It might also be considered a per face fee. So we'll just put per face there. And basically that is a level charge. Now typically this is going to be the largest charge on the policy for the first 10 to 15 years. And it's what makes these contracts front loaded in terms of the fees. After 10 to 15 years, this per unit charge, this per face fee drops off. Now what's important about this per unit charge or this per face fee is it is based on the initial starting death benefit. And so whatever your initial starting death benefit is, that's going to be directly correlated to your per unit charge, your per face fee. And if you try to drop the death benefit later, that fee is going to stay the same. So it's not going to change once you start making changes to the policy later on in the policy life. It is fixed for a set amount of time based on the starting death benefit, and it's going to be the largest fee on the policy for the first 10 to 15 years. That's the per unit charge or the per face fee. The next one is going to be your cost of insurance. The COI charges, they really ebb and flow. A lot of people like to say that they're a straight line up. You know, starts low and to the left and ends high and to the right, but that's not actually how it works. It's going to ebb and flow based on a very simple equation, and that is your death benefit minus your cash value times the COI factor. So there's a factor associated with the cost of insurance. That COI factor gets multiplied across death benefit minus cash value. So in a properly structured policy, as your cash value increases, you should actually be paying for less insurance, less and less insurance. The cost of insurance factor might go up, but the number that it's multiplied across should be shrinking, which really should kind of level out your fees over the life of the contract. The next type of fee that you might have would be something like an asset-based charge. Now, these are getting more and more popular as companies move to these asset-based charges to support multipliers and bonuses. We've talked about that in some other videos. There are some really big companies out there that have huge asset-based charges. We're not a fan of big policies, or rather big asset-based charges on policies, because really what it's doing is it's shifting the risk to you instead of the company bearing the risk for the returns, but that's asset-based charges. And then the last one that we'll add here is just going to be rider charges. So if you're adding things like long-term care, chronic illness can sometimes have a rider charge depending on the company, liquidity riders, those can all have different rider charges. So those are the 5 main fees that you might see on an indexed universal life insurance policy. And again, if you want more of a detailed breakdown on the fees and how they look, I would encourage you to go back to that video that I did in 2019. It's still a good video. They're old products. Those products aren't being sold anymore, but it still gives you a good framework for how to look at a new indexed universal life insurance product through the lens of fees. But the purpose of this video is really to highlight this concept. I get asked all the time, hey Matt, what's the best IUL with the lowest fees? Or what's the IUL contract that's going to have the lowest fees for the life of the policy? And while that seems like it's a really good question, because nobody likes paying fees, I think that it misses the mark a little bit. And the reason it misses the mark a little bit is because sometimes when you pay higher fees, you actually get more in return. And you know this because you experience it on a daily basis when you go to the supermarket, or when you go to the auto dealership, or when you buy any type of high-priced item. The fees should relate to the value, right? If you're paying extra fees for something that doesn't give you extra value, that would be a worthless transaction to you. But a lot of times we actually seek value, and we don't seek value by saying, what's the thing that's going to cost me the least? And a great example of that is my kids get an allowance. I have 3 kids, and they get an allowance every week. And for the first probably 4 to 6 months of them getting an allowance, they would blow it every single week at the dollar store. And what happens when you buy stuff at the dollar store? You go home, you play with it for 30 minutes, and it breaks. And pretty quickly, my oldest son started realizing that, hey, the dollar store might be cheap, but it's not actually a good deal. And so he started seeing things through the lens of, let's forget about price for a second. Is it a good deal compared to what I'm getting in return? And that's exactly where we want to be when we look at indexed universal life insurance contracts. Are you getting a good deal for the fees that you're paying? We don't necessarily care if it's the lowest fees. Is it the lowest fees with the most value? That's what matters. And so I've got an example here that I want to look at. And really how this is going to shake down is I've got 2 policies. It doesn't matter which policies they are, because this is just a framework for you to start viewing these index life policies, through a different lens. So it doesn't matter what product this is. What matters is I ran them exactly the same. So it's the exact same policy design with 2 different companies. One is cheaper than the other, and yet the other policy that's more expensive is going to have more cash in it. And so that's ultimately, I think, what we really care about is we don't mind paying fees as long as we're getting value for the fees that we're paying. So let me get to my screen here, and I'm going to show you exactly what we've got. So all I did here is I went into some of our illustration software. I ran 2 illustrations. This is $100,000 a year premium for 10 years minimum death benefit design. I did that with 2, and then I obviously copied all the values, put it into Excel. I did that with 2 different policies. So here's the second one, $100,000 a year, 10-year design. I've got all the fees, I've got all the cash values, and all I want to do is I want to compare them. And so when we look at the costs, because that's where we're going to start, we've got costs of policy 1 versus costs of policy 2. Now, if the number is green, that means it is cheaper. So in the first 10 years, policy 1 is cheaper than policy 2. But then you'll notice after the first 10 years, starting in year 11, policy 2 is cheaper for the rest of the policy life. And what I really want to focus in on is the differential. So how much cheaper? Well, for the first 10 years, this is a running total. So in year 10, policy 1 is cheaper by just under $1,500. Okay, it's cheaper by $1,500. When we go out to, let's just say, policy year 30, policy 2 is actually cheaper by $16,000. And so when it comes to this particular policy, we clearly have 2 IUL contracts that are both doing $100,000 a year for 10 years, minimum death benefit, maximum cash, and one is cheaper long term. So for all the people that ask me the question, hey Matt, I want the cheapest IUL policy. Well, in this particular case, if these were the only two options available, policy 2 is cheaper than policy 1. And so if that's the only lens that we look through, we buy policy 2. But what's important about this is also comparing the cash between these two policies. So we've got cash in policy 1 and cash in policy 2. And you'll notice that policy 1 has more cash in every single policy year over and above policy 2, every single year. And so what I want to do is I just want to go to the highlighted areas. So in year 10, policy 1 is, marginally cheaper, $1,400 cheaper than policy 2, and yet it has $60,000 more in cash. When we go to year 20, you've paid $20,000 more in fees for policy 1 over policy 2, and yet if you would have just seen this through the lens of give me the contract with the lowest fees, you would have bought policy 2 and you would have had $166,000 less in cash over policy 1. If we go out to year 30, the trend continues. Yes, you're saving $16,000 in fees in total, but you're losing $342,000 in cash. And if we go out to year 40, yes, you've saved $22,000 in fees, but you've lost $769,000 in cash. And so you may be wondering, how in the world is this possible? How is it that one policy is cheaper and yet I have more cash than the other? Well, it's actually pretty simple, because one of these policies has low caps. And I use the S&P index in both of these examples. So one of these policies has a much lower cap than the other. And so what that means is 30 to 40% of the time when the S&P hits the cap, and it almost doesn't matter what the cap is, 30 to 40% of the time the S&P index is going to hit the cap, even if the cap is 14, 15%. All of those years where the S&P caps out, policy 1 is going to recognize a higher return. It is. It will. It doesn't matter how it's structured. It doesn't matter how much money you've put in. If you have two policies and you do the exact same thing with those two policies, and policy 1 has higher caps than policy 2, policy 1 is going to get a higher credit 30% of the time. Now, I'm estimating based on past historical data, but that's how it's worked out. 30% of the time, the policy with the higher caps gets a higher credit. And so, would you rather pay $22,000 extra in fees in order to capitalize on, in this case, $769,000 in additional growth because the cap is higher? And anybody who looks at this objectively is going to say, absolutely, I'm getting a lot of value for the additional fee that I'm paying. And that's really what matters when it comes to Index Universal Life. Do fees matter? Absolutely they do. What matters way more than what you're paying in fees? Are you being compensated for the fees that you're paying in return with additional value? And that's how we look at things through that lens when we talk about Index Universal Life Insurance policies, or really anything that we're helping people with, whether it's an annuity, whether it's a whole life policy, whether it's cash value policy, whether it's a custom money management portfolio. Are you being compensated for the fees that you're paying? So hopefully this has been helpful. Again, I just want to shift the paradigm on how we look at some of these different products that are being sold in the marketplace today. Fees can be a terrible thing, but sometimes you'd like to pay a little bit more in fees in order to get something in return. And that's what we try to focus on here. So let me know if this video has been helpful. If you're looking for a policy review or a policy comparison, you can go to our website, leveragewm.com/IUL-review. I'll link it in the description below. If you haven't already done so, please subscribe to my channel. Click the bell to be notified when we post new content. We're always trying to add value and make sure that you avoid making decisions that are going to cost you in the long run, which is ironic because we're talking about fees here, but we want to make sure that you're getting the best bang for your buck no matter what you're doing, whether it's annuity, financial planning, life insurance, whole life, IUL, variable life, custom money management for portfolios. We do all of it, and the goal for us is to make sure that you're making great decisions with your money, and these videos are a way that we try to help do that. So hopefully this has been helpful. Let me know what questions you have in the comments below, and until next time, take care.